I can actually see some surprises to the upside, and I think there will be surprises to the upside.
Even with these cap rates and the bases that you're seeing, a lot of people are not putting chips on the table.
You're seeing that these deals just get bid up to a point where it's like, let's just buy something stable.
The GFC was a lot worse. There was no liquidity in the market.
And in any business, in any industry, you want political certainty, and that is now back in California.
A CD, Bitcoin, and a value up in multifamily deal.
I mean, it's hard to argue against Bitcoin,
Yeah.
right? So right now, like Bitcoin, it's pretty hard to argue right now with Bitcoin.
All right, guys.
All right.
How's it going?
It's going okay. It's
Okay.
better than some, worse than others.
Yes. Okay, I think is the right way to describe end of 2024 and beginning of 2025.
Can't ask for much more than okay.
Yeah,
And
exactly.
we're very excited to have this year come to an end, right? Really start moving forward with next year with everything going on.
Agreed.
Yeah.
How's your guys' Christmas?
Christmas has been pretty good.
I saw you lit the menorah.
I lit the menorah in North Bay
Beautiful.
Village. Yeah, I'm friends
Beautiful.
with the rabbi over there. I went for the candle lighting, for the menorah lighting, and he walks up to me and he says, "Hey, Max, do you want to light the menorah?" I said, "Sure." And he pulls me over. He says, "Okay, you're just going to get on the steps. You're going to say a speech. I'm going to give you the blessings, the transliteration of blessings, and that's it." I'm like, "Oh, is that all?" So it was really fun, though. It was really nice, and it's nice to have a week or two off.
You've been living here for how long now?
3.5 years.
3 years, and you're already ingrained in the community.
That's right.
You're a mensch. Beautiful.
Thank you.
Mitch, what did you do?
I flew back. I was in Colorado the week before, but I just flew back on Tuesday night. So yesterday we were invited by a few families from school. We got together and it was really nice. It was a mixture of Hanukkah and Christmas, and we started at 3, we ended at 9, and we had, a bunch of kids running around playing soccer and eating and drinking and just, catching up with, new families that we met living in Miami. So it was great.
Beautiful. How's the transition been for you guys overall, coming to Miami from being born and raised in LA?
I mean, it's been great for me. I mean, I'm obviously enjoying living in Miami a lot, and I think through the Jewish community and especially through the school, we've met a lot of families that have recently moved to Miami from New York, Chicago, all over the country, and it's been great to actually go out and meet new people. I've lived in LA my whole life, so it's kind of refreshing to go out and meet new people. But it's been great.
Nice. Max, would you say the same?
I love it here. It's amazing. I don't think it's any secret that the post-COVID, call it last 5 years, have not exactly been California's and the West Coast golden age. It's been a tough time there, and it's been really exciting to come here where the climate is much more pro-growth and pro-business, and everyone's really excited to be here and be contributing to the business community and the community, and love the schools here, love the people here. I love how you have this great mix of beach and water, as well as urban living, metropolitan living. It's very global. It's very diverse. It's an amazing place to live. Super happy.
Yeah, I mean, now living here for over 2 years, and you guys poaching me from the West Coast office here to the East Coast, I would say it's amazing here. The lifestyle, the excitement, everything is just so alive here. And a lot of great, from a business perspective, a lot of great markets that we're in, including a couple of deals that we bought this year, Bridgewater and Fieldstone, which super excited about.
Yeah, absolutely.
So let's, I guess, reflect back a little bit in 2024. What were some of the biggest surprises that you guys saw this year?
I would say the two biggest surprises are transaction volume probably still looks something like 2023. And I think everybody expected it to be significantly better, and it really wasn't. And that goes probably back to surprise number 2. And on interest rates, I think everybody was expecting a lot more rate cuts and a lot earlier in the year. This time last year, bonds were rallying like crazy. And I think both the 10-year and the 5-year were in the 3s. And everybody was just expecting, things to kind of get back to normal, whatever you call normal. But, probably have SOFR somewhere in the 3s and things kind of getting back to normal. Sellers coming off the sidelines and just a little bit more robust of a marketplace. And those things didn't happen. those I think were the two big surprises of 2024.
Yeah, I think the higher for longer was a bit more of a surprise towards the second half of the year than people expected in the beginning. I think in NMHC, there was a lot of optimism last year, and people were excited for Q3, Q4 to come along so that it would be in a lower interest rate environment. And we saw that. We actually saw that for a little bit when treasuries were in the mid threes and we locked on Fieldstone Glen, but it wasn't long enough. And I think the election also, election years are always kind of weird in its own way. But I think that's what people are expecting this year. Do you think that's going to happen this year?
You know, I do. I think actually a lot of people are expecting higher for longer and still more muted transaction volume and values probably not to move much, but I can actually see some surprises to the upside. And I think there will be surprises to the upside. Yeah. So in the last Fed meeting, the press conference didn't go well. As we sit here today and recorded this pod, 10-year treasury is at 465, 5-years at 450. I expect both of those to be a lot lower this time next year. And I think inflation will continue to come down. I think the new government will start to cut costs and close the budget deficit. And I think with that, even though you have the tariffs and, that whole thing, I think as long as the budget deficit is closed and expenditures are coming down, and bonds will rally, I think we'll have a better interest rate environment. Mm-hmm. And I do think what everybody expected in 2024, a lot of that will happen in 2025. Even though the dot plot says 2 cuts, I think we'll have more.
So you think more than 2 cuts?
I do.
Yeah. Where do you think it's going to stabilize at? I guess treasuries. Where do you think treasuries are going to stabilize at in 2025?
Well, I could see in 1 year from now, December 2025, I think we'll have 3 or 4 cuts, probably closer to 4, which puts the top end of SOFR at 4.5. I'm sorry, 3.5, because at 4.5 now, it really puts it around 3 1/3. And if SOFR is at that level, and I think if the markets believe there will continue to be cuts into 2026, then I could see the 5-year and the 10-year probably being around that level. 5-year probably being 3 1/3, 3.5, 10-year being about 3.75.
So you think the treasuries, so right now SOFR is also kind of at 4.5, right?
Correct.
So you're saying in 2025, you think they'll still be at the same level, but probably a little bit lower than today?
I'm saying this time in 2025, in 1 year from now, we'll have 4 cuts. I think the top end of SOFR, that puts the top end of SOFR at 3.5. So if the yield curve normalizes, which it will, then that puts the 5-year probably, mid to high, like 3.5, 3.6, 3.7, and the 10-year probably 20 basis points above that.
Yeah. And one of the questions I've been asking some people is, you're seeing SOFR now starting to be a little bit, it's tied right now with treasuries, but maybe it's trending to be a little bit lower than treasuries. And I guess this is a good question for you, Mitch. Do you think SOFR dropping lower than the treasuries will change the lending environment, or will it need to drop significantly more? At what point do you start seeing a shift between fixed rate financing to maybe people getting back to floating or bridge?
I think people are being very cautious with floating rate financing, especially in the last few years. I think there's been a lot of multifamily groups that utilize floating rate debt. And, back then with interest rate caps, you could buy a 2-year rate cap for, 20 basis points, 15 basis points, and they expired. Obviously, I think a lot of people wish they bought longer caps. So I don't expect a lot of borrowers to switch to floating unless you have a substantial reduction in SOFR. I think if you look back, SOFR back then was, 0.5%, 60 basis points, 70 basis points. A lot of people were borrowing that, on floating rate debt because it was cheaper and you're able to get more proceeds. Here, if you actually compare side by side, you're not getting more proceeds just by going floating rate debt. Yeah. So what's your upside?
Right.
I mean, people utilize floating rate debt because in our case, for example, you had prepayment flexibility. That was the most important, right? Because you didn't want to do a 10-year loan and your business plan was to buy property, renovate, and sell in 3 years. If you got fixed rate financing, you're locking yourself in with call protection, whether it's yield maintenance or defeasance, whatever you choose. So I think a lot of people are going floating rate for that reason. But as of right now, you're not getting much upside by going floating rate. So you might as well stick with fixed.
Yeah. I also feel like the business plan on these deals, pre-rate hike, there was a lot more upside that you can bake into the business plan. Now you're seeing maybe some of that upside lessen, where there's not as much rent growth as there was pre-rate hike. There wasn't as much renovation upside that justified the ROI. So I think looking back, like the deals that we bought this year, there's a good amount of upside down the line potentially, but maybe not today.
Yeah.
But they're still great buys because they're at a great basis, they're at a great yield, they're positive leverage day one, and they can stand on its own 2 feet.
Yeah. Well, I mean, it kind of goes back to you were asking about kind of, things that surprised you last year. I think for us, and I think a lot of multifamily groups, operations was very challenging. And I think with inflation being as high as it was, a lot of people were obviously, not renting apartments that were renovated, right? So you started losing kind of this big ask
ROI.
premium on all the renovations on ROI. So, for the first time, a lot of operators were looking when units would turn and become vacant, they weren't actually going through and spending the full renovation dollars because there was only a $50 premium. So then what's your ROI? It's 3, 4, 5%. You're not going to spend, 10, 12,000 a unit to get, a return like that. So I think, myself, I'm personally excited for the new administration.
Yep.
I think there's going to be a lot of, tax cuts that were proposed that will give people a little bit more disposable income. And maybe start seeing some of that premium come back to the market. And number two, what surprised me, the second thing is just, you would think that Max mentioned transaction volume. People, even with these cap rates and the bases that you're seeing, a lot of people are not putting chips on the table. I expected at least the second half of the year, a lot more institutional equity groups would come back into the market, especially after seeing Blackstone go in, KKR going in. You kind of would think, okay, these guys are buying kind of what they feel is at the bottom of the market, but you just didn't really see a lot of other groups step in. So I think next year things will change.
Why do you think that is?
It could be any number of reasons. I think a lot of people in real estate had legacy deals, right? A lot of funds, institutional opportunity funds were invested in a number of different asset classes, obviously office being one of them and other deals. So maybe they were getting, hurt on the other deals and they only had some capital left to allocate and they just didn't think, will prices go lower or is this the bottom? So I think people were just nervous about putting some chips on the table and just kind of waiting till the new administration comes in and see where interest rates are going. So I think all of us were just surprised to see the 10-year bonds go up that much, right?
Yeah.
With the new administration coming in. But I think a lot of people were concerned that with all the new tariffs, that was the big question, right? Is inflation going to go back up? So we'll see how that plays out next year.
The whole tariff thing, I don't know, that it seems to me like the crowd is saying tariffs are inflationary, which they definitely are in the very, very short term. So if a washing machine goes from $1,000 to $1,100, yes, I guess that's inflationary. But at the same time, when prices on products rise, that brings down demand, which will theoretically hurt the economy because products will get more expensive and the demand for those products will go down. So the sales of those products will go down. That's more recessionary than inflationary. And that can actually help interest rates. I don't know. I mean, we'll see what happens, but I think it's very hard to predict. And there are a lot of things that can make rates and our world go in either direction.
Yeah, it's true for sure.
We saw tariffs. Sorry to cut you off, but we saw tariffs during Trump 1.0 and there was no inflation.
Right. I think a lot of people are pricing the tariffs at what the rhetoric is, but I also think there's a lot behind the rhetoric sometimes where tariffs can be used as a negotiating tool with other countries and more as a threat than to actually be implemented day one.
Correct.
So we just have to see how it plays out.
Yep.
Looking forward into 2025, one of the things I guess that we were doing internally was looking at all the supply, demand, immigration patterns, basic metrics that we look at when assessing our markets. After looking at some of those, what are some of the markets you feel most bullish on heading into 2025?
I'm definitely bullish on out of favor markets. I love what's going on in Atlanta. We just bought a deal in Atlanta. Strong demand. Atlanta's going to have a lot of recovery. People are generally poo-pooing Atlanta because of all the issues with evictions and delinquency. But if you buy good product in good markets, that's not going to be an issue. And also, we're kind of sort of on the other side of this. Like, yes, there are certain counties that still have backup of evictions, but a lot of the counties have kind of worked through it and it's back, not to normal, but it feels like typical type of like blue state type eviction timeline where it's 3 to 4 months. So I think Atlanta's a super interesting market, and I like the West Coast. I mean, a lot of people again are not in love with the West Coast because of the politics. But if you look what happened election day with Costa-Hawkins, for the third election in a row, the repeal of Costa-Hawkins did not pass by 20 plus points. And Michael Weinstein and the AIDS Healthcare Foundation can no longer bring that to the ballot. So now you've got political certainty. And in any business, in any industry, you want political certainty. And that is now back in California with regards to vacancy control. So I think that's huge for the market there. And look at our portfolios. I mean, we've got a pretty good lens into the West Coast businesses, the Sunbelt businesses. And right now, West Coast is doing very well. Our portfolio is doing very well because there's no supply. And there's something to be said for being in supply constrained markets during a downturn.
Yeah,
our occupancies are strong. Rent growth is ticking up a little bit. So yeah, sorry, you were saying?
No, I was just agreeing with you. I think what we saw rate hike was a glut of supply hitting the nation, but some of the West Coast markets didn't see that as hard as some of the Sunbelt markets. And we're seeing the benefits of that today in the West Coast markets. We're seeing places like the Bay Area, Portland for sure, that hasn't seen the supply wave that maybe some of our Sunbelt markets have seen. So I definitely agree that there's a bullishness there. Back to Atlanta, I definitely agree with that. I think the rhetoric of delinquencies in Atlanta becoming an issue is a little bit overplayed at this point. I think you're starting to see some of those delinquency issues creep up into a lot of other markets where people are still paying premiums on the yields, and you're getting a really good yield in something like Atlanta. We just bought an early 2000s deal in Atlanta for a 6.25 cap and locked in a low 5% rate. I don't know where else in the Sunbelt markets, unless it's a tertiary market, where you can get such a good yield for a great quality asset.
Yeah, phenomenal. And also we've got supply falling off a cliff, hopefully in 25, 26.
For sure.
Deliveries. I mean, that's where I would go with the crowd. Generally the consensus is we'll have really strong rent growth because of supply ending, the big supply pipeline ending, the biggest supply pipeline in probably 40 years is ending. And we should have, once that absorbs, we should have really great rent growth.
Mitch, what are your thoughts? Where are you bullish on heading into 2025?
I like the suburbs of Portland a lot. I think, as you guys mentioned there, Portland did a great job. They were building so much there, and they basically put, an X on new development in terms of just how many units they were able to build. So I think Portland's doing great. All of our properties in the kind of first ring suburbs are performing great. We're not having any operational issues there. And I still like the Southeast, especially in Florida. I mean, I really like Orlando, and I do like Miami a lot. I think there's something to be said that, the insurance is still pretty high for all these properties, right? And you got to assume, if you look historically, insurance rates will start coming back down. More insurance companies will come back to the market. It'll get competitive again. And as of right now, you can buy some of these deals at a great basis. We used to spend $700 a unit on insurance and went all the way up to $2,400-$2,500. It's come back down a little bit. But if you're able to get a master policy like we were, that's even lower. So I think today, if you're able to buy a property and pay, like you said, a 6 cap going in, obviously not in Miami, but in Orlando, on a good vintage deal with some kind of upside, and insurance is $2,200 a unit, that's another value add you're able to capitalize on going in the future.
Yeah, I think when you can buy a deal and make sense of a deal today with current insurance prices, you will get the upside down the line when things stabilize. You don't necessarily have to underwrite that, but you know that that can come down the line once things stabilize. I think also, besides the high prices of insurance, it's the volatility, right? And us getting a master policy is huge. It allows us to bring stability on our deals. And I think some of these standalone policies, it's not about the price being high going in. It's about maybe this will double down the line and you can't really underwrite that risk. But when you have a master policy, you can stabilize some of these premiums year over year.
And then there's more I think we could do with that, right? Like we've been talking to our insurance brokers, and Mitch and I have been talking about getting a captive and forming a captive, and that will help bring down costs even further. So things will head in the right direction with insurance. Interest rates are a big part of it, as we all know. Interest rates, when the big reinsurance companies put their capital on the sidelines because they can get 5.5% risk-free, they have to write a lot less risk, and that makes premiums skyrocket. That's what we experienced in 23 and early 24, and now it's, with rates coming down, it's easing.
Yeah, I think one of the topics that insurance plays a role too is the type of vintage deals that will be bought. There's some older vintage deals that might be a little bit harder to insure. And you're seeing a lot of sales today being more on the core plus side and a little bit less on the value add side. Trion's strategy up until probably recent years has really been buying some of the B or C type of assets and making them into a B or A minus. How has that strategy changed heading into 2025? How do you guys see things shifting of what Trion's trying to target today versus what our investors might perceive us targeting years in the past?
Well, look at the two deals we bought this year, Fieldstone and Orlando. I think we are still looking for, older value add deals. We're stepping away from early 70s, unless it's the 70s with good bones and actually that had a number of CapEx items completed, right? So if you can still buy a good deal and get something and get actually a pricing discount for it because it's older vintage, sure, of course we'll look at it. If you can buy something in the high sixes, right? But we're not going to buy something in, high fives on a 70s deal and say, okay, we're going to grow it to a 7, right? Instead, what we would do is we'd buy something like Fieldstone, where you can buy it at 6.25 day one, and you still have some upside, but now you're getting a newer vintage deal. You have positive leverage. So it all comes down to pricing, right? But I think overall, we're stepping away from older products because as years move on, you're starting to see systems go, mechanical issues, you name it. And we really want to stay in the 80s and 90s, but it's harder to buy newer vintage. Sure, all of us want to buy core plus, but at the same time, you have an investor base that needs a certain return, and it's tougher to get to a mid-teens, 16, 17 if you're buying core plus. So it just all comes down to pricing. I think that's why recently we've been bidding on so many deals, but we haven't been competitive because we're conservative in our underwriting and we're not seeing a lot of core plus deals come our way.
Yep.
The volatility in the bond market doesn't help either. Like, you're out there trying to bid, and these 100 basis point swings, it's unheard of. I've never seen anything like it in my career. And I started in the business back in 2002. And there probably wasn't much of it beforehand either, other than the 80s. I mean, this is just insane. It's really, really hard to price these assets. So one other thing I would really hope for and look forward to in 2025 is less volatility in the bond market. This is just, beyond the high rates, the volatility of the rates makes this business very difficult.
Yeah, I think stability is key heading into 2025 and will allow us and other buyers and even us on the sell side to have the bid-ask spread narrow to where we can actually make deals. So it makes sense. I would say another point about the value add deals current environment is you're seeing that it's a little bit tougher to insure. You're also seeing that there's an uptick in delinquency and collections in some of the older vintage assets. And so you need to get to a premium and cap rate where you're getting paid for some of that insurance risk, getting paid for some of the delinquency issues. And I think today you're maybe not just seeing it because it's hard for those sellers on the other side, which we're also part of, capitulating to a yield that makes sense compared to where things were bought pre-rate hike. What's your guys' thoughts? We buy a lot of suburban, and what we're seeing is that there's a lot of supply in the urban core today, but that's falling off a cliff nationally, some more than others. What's your thoughts on buying suburban versus urban? And do you think there's going to be a change in dynamic heading into 2025 of maybe an opportunity buying newer stuff in the urban core where there's a little bit more supply today, but that might be absorbed down the line?
Sure. I mean, look, we own some properties in the urban core. We've owned throughout the years in the urban core here and there. Most of our business is first ring suburb to a primary market, and we've done very, very well with that strategy, and we'll continue that strategy. I don't think there's any need to shun the urban core, but the suburbs have just done very well. And as these Gen Zers, millennials, not anymore as much. They've already now gotten a little older, but as the younger generation ages and they have kids and they have families and they need to move to the burbs, that bodes very well for that model. So we love that model. We'll continue with that model. It's great for rent growth. It's great for renewals. It's just strong, stable cash flow. So definitely don't plan on altering that much moving forward.
I mean, look, the urban core is interesting. I think it's specific by submarket, right? In terms of how much supply you have. On the West Coast, we've looked into buying downtown LA for a while just because prices have gone down so much. But the scary part about buying urban core is you're seeing concessions go up so much, on new buildings. Sometimes developers are offering 2 months free, or 10 weeks free. So you have this problem where you get renters in and then, you give them 2 months free. And then imagine after a year, they're just going to go to the next building and get the same concession. So it's really hard to underwrite that. When does that concession go away?
Yeah.
And then even in Northern California, you saw some buildings trading at 30-40% discounts at peak pricing in San Jose and in Oakland. And they're almost giving 3 months on a 12-month lease. And what's happening is after 12 months, the next tenant's going to go into the next new building. So it's really tough to underwrite that. And how are you going to, what are you going to assume? When does that concession go away? Right? Like you got to really understand the supply and understand when, lease rates will go back up. So I would love to buy an urban core. I think we've just been hesitant for that main reason. So we haven't seen anything come across our desk where it's a great deal. I've seen a lot of stuff recently in San Francisco, and I love San Francisco. I used to spend a lot of time in San Francisco, and I think people who are now putting chips on the table and buying some of these office buildings at, a couple $100 a foot, $100 a foot, and just paying cash for them. And eventually they're going to do great, right? Because people will come back to these urban core markets. And you're starting to see some multifamily trade in urban core markets in San Francisco as well, and I think that's a great play, but you just have to have the right capital and the right partner who understands and do a long-term play there. They're going to do great.
Yeah. I think one of the ideas with urban cores, there's a lot of concessions today, and you're seeing those renters that choose the concession, right? And you have to look at the absorption numbers to see if that's going to continue. I think you can't paint it in a broad stroke. Some markets might be struck with supply issues for as long as we can see. And some, you're seeing the absorption numbers also improving as supply has increased. But I do agree that you're seeing a little bit better absorption in the suburban markets than some of the urban ones, which we usually are connecting on much better.
Yeah, absolutely.
I want to move to distress for a sec, or maybe the lack thereof distress that we've seen on the sale side. I think there's been a lot of pain the past 2-3 years, but it hasn't really translated to distress sales. Do you think we're going to see any of that in 2025, or has that ship already sailed and we're starting to see workouts and maybe not seeing the distress that people hoped for?
I don't think there's going to be some huge wave of it, but definitely don't think that ship has sailed. I think that if rates continue to stay very high for much longer, and we are in a very much higher for a longer period, then there's going to be just more distress. There's just no question about it, because these borrowers can't refi and can't sell if they're over leveraged. So there's going to be distress. It just really all comes down to interest rates. It comes down to interest rates and values. And if things start to go in the right direction over the next few months, then there's not going to be distress. But if it's higher for longer, then there will be more distress.
Yeah, and I feel like the past couple of years, when there was a distressed deal that hit the market, it just got completely bid up because there wasn't so many of those distressed deals that actually translated to a sale. There are so many other ways to save a deal besides selling it at a loss. And I think what you're finding is, there was a deal in Denver, for instance, near Trail Point that sold at a lower basis, but you had a lot of CapEx issues. You had to put bridge debt financing on it, and your cost of capital just got higher and higher, and your basis ended up being what we bought Trail Point for. And it's like, wouldn't you rather just buy a higher yield day one and have less of a headache than to buy something at a lower basis that you're going to be all in for? So I do think there might be, as you said, some more distress, but if there's not a whole wave, you're seeing that these deals just get bid up to a point where it's like, well, let's just buy something stabilized.
Absolutely. Makes a lot more sense. I remember that from the GFC, when something would hit the market that had REO in the subject line of the email, or there was some sort of distress, it would always sell at a ridiculous number because it had a great story, and people would overbid for the story, but ultimately it didn't make economic sense because you're just taking on a lot more risk for the same return.
Yeah. And I think this would be helpful going back to the last downturn that I was a little too young for, but you guys were well in it, the REO and buying non-performing loans. How has this been different than back then for you guys?
Well, I think the difference is here you have mostly problems with balance sheets, capital structures, maturities, and the economy is generally okay. It's not terrible. Obviously, it's not great with inflation and affordability issues and interest rates. And that's affecting everyone in America. But back then you had 10% unemployment, if not higher. That was the published rate. So you had real unemployment higher than 10%, job loss everywhere, recession. It was a true recession. It was the second worst recession in American history, the Great Recession. And it was years long. And because of that, you had a lot of vacancy and a lot of evictions. Rents plummeted because the incomes just weren't there, and the economy was in tatters. So this downturn is not nearly as bad as the GFC, and it's also different in that sense.
I think it's been different for us. I mean, look, I think like the GFC was a lot worse. You basically had companies like Lehman Brothers completely going out of business. I remember there was a point in time that there was no liquidity in the market. Like if you had a maturing loan, you could not get a loan. There was just nobody there funding deals. So you got to that point. If you look at it right now, even when the market turned, for multifamily especially, the agencies were still there, right? So obviously your cost of capital has gone up a lot, but there was still liquidity in the market. So you can't compare the two. For us, it's been a little bit more challenging. We owned a lot more, and we also had more floating rate debt, right? And that's been the challenge, because when those floating rate loans come and the interest rate caps went from 25, 30 basis points to 200, 250 basis points, to challenge going out and doing capital calls and raising money. So they both have their challenges, but the GFC was obviously a lot worse.
I think the lack of liquidity in the GFC during now is definitely the glaring issue, right? The liquidity that you're seeing today is still being deployed. It's still an active year in real estate, but it's not necessarily in sales. So I think with the wave of distress that you saw in the GFC, maybe it wasn't all getting bid up, and we were able to pick some really good, attractive deals. Here, because there's not as much of a wave, you have to find the needle in the haystack, and that could be difficult, which we did have some success in, but it could be a little tough at times.
I think people just are also underwriting to deals differently, right? I think before, like you mentioned, because of the upside, you would see people pay, cap rates below kind of fixed rate financing. So now you see a lot of groups kind of focusing on more on the cash and cash aspect and less on kind of the renovation premiums and selling at a premium in year 3, right? People are really focused on cash and more than I've ever seen.
Yeah.
So people really are focusing on the in-place cap rate versus what is my actual rate on the loan, right? And there has to be some kind of premium there. So you're just not seeing buyers, pay premium pricing unless it's in markets like Miami, right? That's kind of like anomaly where you're seeing, I think overall Miami's probably priced 50, 60 basis points lower than the rest of the country.
But Miami, Miami is its own standalone market. It's graduated at this point to be another LA, New York in that regard. And it's been tough to find that yield that we've seen success in some of our other markets. I guess going back to cash flow, what is Trion heading into 2025 targeting from a cash flow perspective and an overall IRR perspective? Has that changed?
I think we'll probably just keep underwriting to the same IRRs we've always underwritten to. I guess Finance 101 tells you shouldn't. We should be underwriting for a higher IRR, but we were never in a really like tight IRR business. We never underwrote to like a 14 gross with a 12, 11 net. That's just not our business. We always underwrote to a high teens and close to a 20 gross. We try to, get to an 18, 19 as the bogey and net mid-teens to the investors, even though we wound up overperforming and always getting a lot more, not always, but typically getting a lot more. So I think we'll probably stay put in terms of IRRs. We just, we need a little bit more cash on cash because now we're competing with JP Morgan, Wells Fargo, and Bank of America's CDs and US Treasuries at 4.5%. So it'd be nice to get a 6% cash on cash kind of out of the gates and have that grow over time.
Yeah. And what would you, I guess, tell those investors that are looking between a CD, Bitcoin, and a value-added multifamily deal about why to invest in real estate? Obviously, completely different risk profiles, but I think at least for the high net worth, you're starting to see that that's really the decision they have, right? So what would you tell them about why to invest in multifamily today?
There are a few reasons. If we're just framing it in the context of how an apartment building competes against CD at JP Morgan, it's very simple. A 4.25% CD is fully taxable at ordinary income. If you live in a high tax state, at 4.25 is actually 2.125. If you live in a low tax state, it's going to be more like 2.8, 2.9, 3%. So you're really not getting such a wonderful yield. Whereas with multifamily, it's sheltered and you'll get 5 or 6% out of the gates sheltered. And you don't have to recapture that until you sell the asset. Significantly higher cash on cash straight out of the gates. Number two, you're buying at a low point in the market. We're at the bottom. We're close to the bottom. So if you factor in where interest rates are probably going, where rent growth is probably going, what that will look like on a 5-year hold, you're probably going to make at least a mid-teens IRR if you're putting your money with a good operator. So I would say those are the two best reasons why you'd want to invest in multifamily right now. It doesn't feel good, right? You're getting 4% and it feels risk-free, and you look at the S&P 500 and that's ripping, although it's probably not going to do that again next year. It's very unlikely if you look at the history of it, and that's got daily liquidity. But, multifamily is looking really, really good for the next 5 years.
I mean, it's hard to argue against Bitcoin, right?
Yeah.
Right now, like Bitcoin, it's pretty hard to argue right now with Bitcoin, especially with the new administration going in. But look, I think right now, most people are probably, getting a little nervous about Bitcoin just as where it's priced today at 100,000, and probably will start thinking about diversifying their portfolio. So I think it always makes sense to be diversified, have money in bonds, stocks, apartments for sure. I think like Max said, right now it's the low point, right? You think the values are down anywhere from 20 to 30% wherever you are in different submarkets. And I think you're going to start seeing some rent growth and values will go up. So I think if you've got the ability in investing in long-term fixed rate multifamily, it's a great, opportunity right now, just kind of where we are in the market.
I like how the value add multifamily space has a good hybrid model of cash flow and yield through appreciation. By being the low point in the cycle, you're seeing that things can improve and there's a path there. But if things don't necessarily improve right away, you're still cash flowing. I think some of these other alternative investments, you either have the speculative investment that's not really getting you the cash yield, or you're getting something that might have a cash yield, but doesn't have the same appreciation. And then the tax benefits are incredible for real estate. And I think that's where we capitalize. We do cost segregation and we do a lot of things to the investment with the investment that allows for tax advantaged returns.
Sure.
Exactly.
Of course.
I guess any other closing thoughts heading into 2025?
We're all very, very excited for the new year. More stability, hopefully, and new government, whatever that means, whether you voted for it or not. I think it's exciting to have change. I think anybody in this business definitely wants some sort of change relative to the last 4 years. So we're really, really excited for what's to come.
I just think, overall, I think this next year is going to be better for us, just in terms of operations and, transaction volume. I think we're going to start seeing some deals that come our way. I know walking into your office and saying like, what's going on? Or Max, like, it feels like this whole year we've been bidding on so many deals and we're just not even getting into the second round or any round just because, we're trying to get a normal in-place cap rate and we're just getting outbid so much. But I think this next year, I think there are going to be some transactions that go through and I think people are going to, have to sell and we'll get some more deals. So overall, I think it will just be a better year for us in terms of buying new deals. And I think the market's going to open up a little bit in terms of rents and some of the properties we own, and we'll be able to start getting some of the premiums that we underwrote initially.
We've underwritten every single deal in our markets, and we have a really strong pulse. And it's not for nothing, but it is telling to underwrite every deal, see where the yields are, and still take a step back and say, all right, this isn't enough right now. This isn't the yield that we need to be at to make this deal work. And I think we've been disciplined. We've been conservative. We've been focusing on untrended returns. And I think it's important now more than ever. And I think that information that we've aggregated through this tough times is going to pay dividends down the line when things do start to open up and there is more stability and we can quantify our decisions rather than investing in a deal that we can't protect the downside enough. So I do think the work that we have been putting in is going to be paying its dividends as we get out of this tough rate hike cycle and start getting into a rate cut cycle with things opening up.
I feel like we kind of have like our own little, co-star subset of like deals, like in terms of underwriting deals, if you look at some markets, you could probably pull up, Orlando and see like, okay, we bid on these 40 deals, between like 80s, 90s, 4+. Yeah. And then, see kind of where in-place cap rates are, values per unit. I mean, it's crazy. It didn't even get anything. We got one deal in Orlando, one deal in Atlanta, and everything else was a head scratcher, right? Like, how are people paying these prices, right?
Yeah.
And maybe we were the ones being too conservative. So hopefully that's going to change.
Yeah, I do think we are at a point where we have our own co-star, and we have LPs reaching out to us. We have brokers reaching out to us. We have other sponsors reaching out, just getting data. And I think by having the best pulse in the market, it's going to pay its dividends when things do improve and it does make sense to pounce.
Yeah, absolutely.
So, guys, looking forward to 2025.
Yes.
Thanks again. And let's get to work.
Happy New Year.
Happy New Year.